NatWest Group closed its £2.7 billion acquisition of Evelyn Partners today, combining Evelyn's £69 billion in assets under management with NatWest's existing £59 billion to create a £127 billion wealth platform. The stock is trading near its 52-week high, yet on the same day, two major analysts looked at the same completed transaction and reached opposing verdicts. That contradiction is the analytical problem. A bank executing precisely what it promised, deploying capital into the UK's fastest-growing financial services segment, and yet the deal's close is the moment when the investment case fractures into two irreconcilable reads. NatWest's 2025 numbers were not ambiguous. Total income rose to £16.4 billion, up £1.8 billion year-on-year. Return on tangible equity hit 19.2%, significantly ahead of guidance. Earnings per share climbed 27% to 68.0 pence. The bank proposed a final dividend of 23.0 pence per share, lifted the full-year payout by 51% versus 2024, and announced a £750 million buyback for H1 2026. On those metrics alone, NatWest looked like a bank in acceleration. Then it closed Evelyn, and the street split.
Citi analyst Andrew Coombs raised his NatWest price target to 840 pence from 810, pointing to the Evelyn acquisition as a structural re-rating catalyst. The logic: Evelyn's client base expands NatWest's financial planning reach, fee income is expected to rise around 20% before any revenue synergies, and the bank is targeting £100 million in annual cost synergies from the combination. Citi's read is that capital deployed into fee-generating wealth management is capital working harder than it does in the lending book. Stickier revenues, lower regulatory capital consumption per pound of earnings, compounding client inflows. The 840 pence target implies the deal has not yet been priced. Barclays drew the opposite conclusion. On the same day, it downgraded NatWest to equal weight from overweight and held its target at 700 pence, more than 16% below Citi's. The Barclays call is not a critique of the strategy, it is a valuation argument. The share price already reflects the good news. Consensus capital estimates have not yet caught up, and the broker wants to see those revised before turning constructive again. Barclays was itself one of NatWest's rival bidders for Evelyn before withdrawing from the process. That matters. The bank that chose not to pay the price is now the analyst telling the market that NatWest overpaid for it. This is the buried paradox. Barclays' own decision to walk away from the Evelyn process and its subsequent downgrade of NatWest are not two separate events. They are the same view expressed at two different moments, first as a bidding discipline, then as a research call. For the NatWest holder, that means the bearish analyst has skin in the game of having been right to withdraw, and the question of whether is not a matter of model assumptions, it is a question of which bank's acquisition discipline will prove correct. The transaction is forecast to reduce NatWest's CET1 capital ratio by around 130 basis points. That is the number Barclays is watching. NatWest's CET1 ended 2025 at 14%, and the bank has already guided to a post-deal target of around 13%, a level it frames as optimal, but which leaves less buffer than the 14% it has been running. The buyback announced for H1 2026 further draws down capital. The bank is simultaneously deploying equity into an acquisition, returning equity to shareholders, and guiding to a lower capital floor, all while the integration of Evelyn's $69 billion in client assets has not yet begun. Running alongside the deal is a separate risk that does not appear in the acquisition press release. Liquidators acting for the collapsed Rockfire Group have filed high court claims against Royal Bank of Scotland, NatWest's wholly owned subsidiary, seeking roughly £250 million. The claim alleges RBS processed unauthorized payments tied to one of the largest local authority financial scandals in England, the Thurrock Council bond collapse, which accumulated £1.5 billion in debt before the council declared effective bankruptcy in 2022. Rockfire Capital and Rockfire Investment Finance are pursuing £70 million and £179 million respectively, and the Serious Fraud Office has already opened a formal investigation, issuing Section 2 compulsion notices. NatWest has said it will defend both cases. A £250 million claim is not a balance sheet catastrophe for a bank with £5.5 billion in attributable profit, but the SFO's active involvement raises the probability that civil disclosure feeds criminal proceedings, and courts since 2008 have been progressively more willing to hold banks liable for payment failures adjacent to fraud. The legal tale does not change the acquisition thesis, but it complicates the capital story at precisely the moment the CET1 runway is shortest.
The H1 2026 results are the first post-integration checkpoint that will carry real signal. NatWest has guided to full-year income of £17.2 to £17.6 billion and ROTE above 17% for 2026. The variable that most sharply separates Citi's thesis from Barclays is the fee income run rate emerging from the Evelyn integration in the first half. If fee income lifts toward the guided 20% increase and client retention holds, meaning Evelyn's existing client relationships survive the ownership transfer, then the Citi read gains ground. Capital is being deployed productively, the revenue mix is shifting away from interest rate sensitivity, and the bank trades below Citi's target with room to close. If the integration stalls, client attrition at Evelyn runs above expectation, or the CET1 ratio compresses further than the 13% floor NatWest has guided to, then Barclays' valuation ceiling gains credibility. The ISA rule changes effective April 2027, which cap cash ISA contributions at £12,000 for under 65s and introduce a 22% charge on cash held in stocks and charge ISAs, create a structural tailwind for NatWest's wealth platform, but only if the platform is actually absorbing the redirected savings. That is an execution variable, not a strategic one. The counter-evidence that a holder must confront directly, the shares trading below key moving averages despite record earnings, inconsistent operating cash flow noted in the articles, and the Rockfire legal tale. These are not thesis killers individually, but they cluster at the same moment the bank has least capital headroom. For the holder, the move becomes an add if the H1 fee income disclosure shows Evelyn's AUMA growing and client net inflows positive, confirming the acquisition is generating returns faster than the CET1 cost compounds. For the watcher, it becomes an entry if the stock pulls back towards 700 to 720 pence, the Barclays valuation floor, and the H1 numbers show execution intact. The trap, in either case, is assuming the 19.2% ROTE of 2025 is sustainable through a period when capital is contracting, legal costs are active, and the integration's first year is the hardest. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.